everyone, and welcome to Coffee, Homes, and Loans. And today we're so excited because we have our amazing manager, Erin Freemal, with Movement Mortgage, of course. And welcome. So happy you're here.
Thank you.
Yeah.
I'm glad we're doing this.
Yeah, so Erin has so much knowledge, so we're going to pick her brain. And today I want to talk about reverse mortgages. I'm so unfamiliar with the program,
Okay.
and most people are.
Yes.
So what are reverse mortgages?
That's a good question. So reverse mortgages are a HUD or FHA backed mortgage. So they're backed by HUD, FHA. They are a program for a borrower or borrowers who are 62 years or older.
Okay.
So you must be 62 years or older. You can use them for purchase money. You can use them for refinances, cash out refinances. And a lot of what reverse mortgage is to help people, one, maybe on a fixed income, right? So as you retire, the goal is to obviously have more money than when before, but somebody on a fixed income that might need to alleviate some dollars every month, because a reverse, what it allows you to do is you don't have a mortgage payment. So it is a loan. There is a deed, there is a note, so it's similar that way as you would think of a regular forward mortgage. But instead of them making a payment to the mortgage company every month, it just goes in essentially deferred interest.
Okay.
So they do pay you do have to pay your property taxes and your homeowner's insurance separately.
Okay.
But what it allows more cash flow, right? So if you had somebody that was on a fixed income of maybe say $3,000 a month and they're struggling, they've got their bills, their normal bills, maybe a car payment and then a house payment. What if you were able to alleviate a $1,500 house payment a month? Right?
I see.
Like what would that do for somebody that made $3,000? So that would be like on a refinance basis. It also allows that borrower to tap into potential equity of their home. So on a reverse mortgage, they're qualified a little bit different. We look at the equity of a property a lot more than a normal mortgage. The age is part of qualification. So the more equity in a property allows them to pull more out on like a refinance basis. But sometimes if there's enough room, we can establish a line of credit as well. So we see huge benefits to not only do they not have a mortgage payment anymore, but then they actually have access to a credit line.
Okay.
And sometimes that credit line is significant.
Yeah.
I mean, it grows over time as well.
Yeah. So if we have somebody that is 62 or older and they currently have a mortgage on their home, by doing the reverse mortgage, they are taking out the monthly payment.
Correct.
And they're not receiving at that point any money back unless they do a cash out refinance.
That is correct.
Okay.
That is correct. So you can, there's different ways, and with the reverse, what I always say is there's a few pieces of information we need from somebody, very simple. Their name, their social security number, their birth date, and the property, the address of the property, and if they have a mortgage. And with just those pieces of information, we can plug it into our software, and it will tell us what options those borrowers have.
Okay, so it'll give you a home equity line of credit, cash out, plain refinance. Maybe they just need to alleviate the mortgage payment and the expenses.
That's correct.
Okay, so that's where it comes into the purchase part. They are pretty much reversing their existing mortgage.
That's correct. So what I see a lot of is, let's say someone's relocating here, or maybe they're downsizing, so they're selling their current home. They may have a lot of equity, so they have assets, right, for the down payment. But again, they're on a fixed income, or maybe their debt to income ratio doesn't work with a normal mortgage payment. So then what we're able to do is they put their down payment down, and same thing. So the information will run that in the proposal, and it'll tell us how much they need down. Typically on a purchase, a reverse purchase, you are looking at about 20 to 30% down.
Okay.
Right? But a lot of times what I find is the borrower's having to put that much down anyway.
Yep.
To make sure they're
because they're only on retirement income at that point.
Correct.
I see.
So similar down payment as it would, but no mortgage payment. So then they just pay their taxes and insurance, and they save all that money a month.
I see. Very good. And so what is that credit requirement, the credit score requirement?
So credit follows FHA or HUD. So you can go as low as a 580 credit score.
Okay.
Again, it will run the numbers. Now, what I would say is sometimes if somebody has a lower credit score or they've had some derogatories on their credit, don't worry. Most of the time, you can still do the reverse mortgage. It just puts them in a program that's called ELISA. And all that means is we do a set aside. So we take some of that money, part of the down payment, or if it's a refinance, maybe some of the cash out.
Okay.
And they hold it in like an escrow or a reserve account. So a hold account. So then in that case, the lender, the reverse mortgage servicer, will make that borrower's taxes, property taxes, and homeowner's insurance payment.
Oh, okay. I see.
So it's an easier qualification than like a conventional would. So it allows for some credit.
A little bit
deals
more
and things like that.
flexibility and things like that.
Exactly.
That sounds really good. So if they have done the reverse mortgage and let's say they do the cash out options and they're getting some money back every month for their expenses, better quality of life, what happens when the owners pass away? Say they have a trust and they leave the house to their children. What do the children do, or the beneficiaries?
That's a good question. So there's a couple of parts to that. One is with the spouse. So if you have a married couple and the spouse can be on the reverse or doesn't necessarily have to be, but once if one of the spouses passes away, the other spouse can remain in the property, can stay in that reverse mortgage. They don't need to do anything to it until they pass. So then if both borrowers pass at that time, depending on how they've set up their estate, right? So if it's in a trust or if they have somebody they've added to title or however, that home will pass to them. The only requirement is that they cannot stay, that family member, children, relatives, whoever inherits the property, cannot keep that reverse mortgage.
I see.
So they give them time. They can either refinance out of it and just get a regular mortgage. They can pay off the mortgage, or they can sell the property.
I see.
And they give them ample time. So it's at least 6 months to allow for them to do what they need to do with the property.
To figure it out.
Correct. And it's just what is owed on the property at that time of passing.
Okay, so what about, okay, so if they sell it and the property has significant equity, those are earnings to whoever the beneficiary was on title.
Correct. So a reverse mortgage is paid off just like a regular mortgage would be. So you find out what the payoff balance is, and then pay that off, and the rest of the equity is theirs.
Yeah.
That's correct.
And because it is an older age, 65 and plus, what is the best practice when you are doing a reverse mortgage? Should you put your home in a trust? Should you add somebody on title? Because otherwise it would go into probate, right?
Yes, and I would say you would want to do that no matter your age or program type. Because if you don't have your home in a trust or set up with a financial service provider, and it's being passed on the way you want it, it will go to probate.
I see.
So that's reverse conventional, whatever that type of property is.
Yeah. And as a side note, when it goes to probate, that means that whoever the relatives are, they wouldn't be able to access the equity or the earnings of the property, right?
Correct, until it's through probate.
Oh, okay.
That is correct.
And then a judge has to decide who gets that money.
That's correct.
Okay, so it gets a lot more complicated.
Yeah, I mean, definitely you want to take care of your house so that it passes to your heirs or whoever it's passing to quickly and efficiently, instead of letting a judge and the courts kind of decide what's going to happen to it.
Yeah. Can you do a gift of equity on a reverse mortgage? So if a son wants to gift the property to a parent that is 62 plus, but the parent doesn't have income, could just the
you
credit?
mean assets?
Yeah, assets or income, and they just want to give them the home.
Well, no, because you do have to qualify with income.
Got it.
So it doesn't have to be an exorbitant amount, but a reverse still does utilize credit and income to some extent to qualify.
Okay, so you need to have some sort of like Social Security, retirement income, sometimes a pension or something like that.
That's
or maybe
correct.
your job if you're still working.
Sure, and we see that a lot sometimes. So we'll see someone that has a part-time job and they're receiving Social Security, or maybe they're receiving pension, and we're able to utilize all that income. And And basically that income just goes towards whatever is on the credit report, right? If they have any revolving debt or any car loans, and then just to what the property taxes and insurance would be on a monthly basis.
I see. Very good. Are there any cons to getting a reverse mortgage? What would be like the alerts to watch out for?
You know, honestly, I love this product, and I think it's underutilized, and I think it is misunderstood. Years ago, reverse got a bad name because there weren't as many checks and balances put into place.
Very
by
predatory
HUD.
back then, yeah.
It was. Lenders were charging exorbitant amount of fees. They didn't have the protection as much towards the homeowner. But HUD really in the last probably 12 years has stepped up and kind of put checks and balances in place. Also, they have lowered, if anyone has had a reverse in the past, or part of why they've got a bad name was the loan to values used to be a lot higher. So you'll notice now when you're running numbers for the proposal, typically on a refinance, you're gonna need, your max loan to value is about 70%, maybe 75%, because they wanna make sure that there's a pretty good sizable equity.
Just in case something happens to the market.
Well, yes, and there's not a mortgage payment being paid by the borrower, but there is that interest still accruing. So when we show the paperwork, part of what prints out in the paperwork is an amortization schedule, which is really nice because it will go over 30 years and it will show the borrowers year 1 through 30 what the potential balance could be on the loan. It also compares it to appreciation. So the goal is to always have appreciation, even if it's 3 or 4%, to outpace the loan balance.
Got it.
So that's why they adjusted the loan to values down to make sure that the loan never outpaces the appreciation.
Yeah, and it's kind of what has happened with all of the mortgage products, even the broker products that are very small list of documents. There's still a lot of checks and balances that have to be made.
Absolutely, absolutely. Yeah. So I feel like it's more misunderstood. When I speak to financial advisors, I find that they're very helpful when communicating with a potential borrower on this loan, because they've got their whole portfolio, right? And so when we're looking at a borrower in their whole life, the mortgage, the house is a huge part of that pie. And so when the financial advisor understands, and I'll send the proposal to their financial advisor, when they understand the benefit of, hey, they just gained $700, $1,500 more a month back in their pocket that they don't have to spend, they can use for daily bills, or maybe they take a trip or do what they want to do, and they don't have to touch their long-term savings, retirement accounts, IRAs, right, which their advisors don't want them to. They're for long-term, but they can access some equity in the home, maybe through that credit line. That's a big deal. Like when I can say to somebody, hey, you can pull $20,000 at close if you want, plus your equity line after 12 months that you can touch is $60,000.
Yeah.
And then the borrower, their financial officer says, hey, that makes way more sense. You pull that as an emergency fund as opposed to cashing out your IRA, right? So there's multiple reasons that I just think they're a great product.
Yeah. So it's just about being informed, and it's very specific to every single client situation.
It is. Every run will be different, but I feel like it's really important to, education is very important, and then work with someone that knows, that understands reverse, right?
Yeah.
That looks at their short-term goals, their long-term goals. You know, I've even sat with borrowers' children, because sometimes that's their concern. Well, what are you doing with the house? I'm going to lose the house. I don't inherit. So it can be a family. I mean, it really can be a family process.
Yeah.
So that everyone feels comfortable and they understand what the next steps are.
That sounds good. Well, I feel very well informed. I haven't done a reverse mortgage since I started in this business. So it's good to have somebody that does it day in and day out. And if you guys have any questions specific to reverse mortgages or what you can do to leverage the equity of your home, please put it in the comments below, and we'll have all of this information that Erin relayed to us on the website, as well as in a scenario of what reverse mortgage looks like. So we'll see you guys next time.
Absolutely.
Bye.